I mean, we'll record it, right? But you can see me good, Rogada. You can hear me good.
Yeah.
Okay. That way I don't have to scream and yell, which is good. So hopefully we can get this done pretty quickly then. Usually 2 people, there's fewer questions. I know yesterday, Tommy, you guys watched the video for Tommy going over, beating, objections proactively and kind of making sure that you narrow the presentation down to either I want to think about it or I can't afford it. Like that's what it's designed to do. It's designed to narrow everything down into either I want to think about it or I can't afford it, right? So if you know those 2 closes and those 2 rebuttals, you can kind of get around all that stuff, right? So the next step in the process of going through the presentation after, you go over term and whole life with them and you become the expert, right, is to basically paint a picture of their situation. So going over the list of concerns, right? Before I go over the list of concerns, I want you guys to understand where they come from, okay? Now, our company itself, we're a union-based life insurance company. We're the only one that exists, right? Meaning we have a very niche market of people. So the people that we do represent are union members, right? You got to remember every one of these unions that we represent has a union president, right? Now, do you guys know how that union president gets to be a president? He's voted in, right? Andrea, exactly right. He's voted in, right? So all the other members in the union vote for this person, right? Because they think he's going to do the best for them, right? He has what's in their best interest at the front of his, table. So what I'm getting at is these union presidents wouldn't approve programs like ours for their members if they were bad for their members, right? Or he would be out quick. So he's not going to approve a program that's bad for his members. That's why we work with 20 to 30,000 different groups and unions. They didn't just go into a phone book and say, this company, let's use them, right? And then they called us. It's not how it works. We're a union, they're a union. They sought us out because of that brotherhood, right? Now, what I want to get to now, because this list of concerns, this is really broken down by our labor advisory board. So the labor advisory board itself, I have a picture of them all here, right? Okay. The labor advisory board is made of about 50 different union presidents, right? Each one of these unions has a president on the board, right? Mm-hmm. So for instance, there's a bunch of them on here. So I don't know if you guys watch football, but DeMaurice Smith, he's the head of the NFL Players Association. Oh, okay. Right? So the head of the NFL Players Association, which is a union, is on our labor advisory board. Right? Other big ones you're going to see, James Hoffa.
Is that Jimmy Hoffa's son?
It's the third.
Oh, the third?
The third.
Okay.
All right, so there's still a Hoffa on the board for the Teamsters. It's been like 50 years. So, and why the Teamsters are important is because that's one of the biggest unions in the state of Illinois. All right, the Teamsters basically started in Chicago, right? And the Teamsters are one of the biggest organizations in the United States. They helped build this city. They helped build Las Vegas. I don't know if you guys have ever seen the movie The Irishman.
Yes.
Right? A lot of that goes into what the Teamsters did, okay? None of it's so legal all the time, but they turned a group of hardworking, immigrants and hardworking Americans into a very big, very powerful labor union, right? They're the ones that started the labor movement in the United States, basically. So to have somebody on the board who's gone through that is huge, right? Now, also on the board, there's like presidents and vice presidents and chairmen. I don't know if you guys can see who this guy is right here. Steve Greer. Steve Greer is on is the executive chief officer for the labor advisory board. He's the president of our company, guys. Right? So to have the president of our company on the president as one of the key figures on the labor advisory board, that speaks volumes. So the list of concerns that are brought to our attention are the main concerns that the union members have. So every single year, the labor advisory board gets together and they talk to their union and they're like, hey, what do you guys want in programs? What do you want us to help you out with? Right? And they bring a big list of concerns to us every year. Right? And instead of hitting our members with 40 different concerns, we broke it down into 6 major concerns. Right? So in your scripts, the 6 major concerns, right, are first one is permanent and portable benefits. Right? That's why our company's set up. You know, most members and most, unions and people that work have benefits through work. But the problem and concern about those benefits is that once that person quits, fires, or retires from that position, those benefits are gone. Right? So we provide our members with permanent benefits they get to keep that aren't tied to their union, they're tied to that person as an individual. So whether they do quit, fire, retire, they still get to keep them. Right? So that's the first concern. The second concern is final expense protection, making sure that if they do pass away, that there's not a $15,000 to $30,000 burden on their family right away. Right? The third concern is income protection, making sure that the paycheck comes into the house every single month. Keep the bills paid, the food on the table, the lights on, or make sure that everyone can use their cell phones. Right? The fourth concern is mortgage protection or rent protection, making sure that their family can live in that house, stay in that same area, not have to change their lifestyle so drastically. And then the fifth concern is a couple of them. It's either child education or making sure that their debt doesn't get passed down. Right? And then the sixth concern is being able to qualify for it and affordability. Right? So I'm going to break down each one of those 6, and we're going to visually kind of represent them on the list of concerns for the members. That's the whole reason behind drawing this out or even having it on our PowerPoint. Like Rogo, our PowerPoint's a little bit different because you're virtual. You can use that list of concerns the same exact way, right? I don't know if you have a pen or anything that you can write on your computer with, but that's what I use, right? But the main reason why we want to do this is we want, number one, to paint a picture of what this looks like, their situation looks like, if one member is gone or the one member of the house is gone, right? The other reason why we're doing this is we're getting them to kind of sell themselves on why they need it. If that makes sense. Because the toughest part about life insurance is the fact that it's not really tangible. Does that make sense? It's not like I'm have a vacuum cleaner and I'm like, look how well the vacuum cleaner sweeps up this dirt. Right? I can't really show you that until this bad thing happens. Right? So it's not really like a tangible thing you can hold in your hand. Of course, I mean, you can hold the paperwork, you can look at the claim forms, you can look at your policy, but it's never going to be tangible until something bad happens. Right? So in order for them to kind of get the point and to understand it, we got to make sure, I don't want to make something bad happen to them, but I want to paint a picture as if something bad did happen to them. Does that make sense? Yeah. So the list of concerns, hopefully this marker's a good one. Oh. The first list of concerns, the first concern is permanent and portable benefits, right? Shouldn't really have to explain it too much here. Maybe just reiterate to them. You know, talking about the permanent benefits should be done in the first paragraph you sit down with them, basically, while we're there, right? Now, the second concern is final expense protection. So final expense. Can you see that, Rogada? Can you see that handwriting clearly? Okay. You're muted.
Sorry, there's a really bad glare on the board.
Is there? Okay, let me try this. How's that?
That's better.
Okay, it's fine. You guys can still your handwriting? Okay, I turned all the lights off. Okay, so final expense. You know, the second concern a lot of our union members have is that they were passing away and their members were left with a big burden all at once. Right? The remaining spouse or the remaining members of the family were left with a big burden right up front. Right? We got to remember where this comes from. If you go to the funeral home or you go get a funeral paid for, when does that funeral director want paid? Right away. That day, right? Typically that day. Right? Normally the way it works is they want half of it up front and then they want half within 60 days. If they don't get that within 60 days, they can charge up to 20% interest on that. It's insane, right? The funeral industry is one of the only industries not regulated by the government. They can charge what they want. There's no set prices. It's not regulated, right? And because a lot of it's tied to land ownership, right? Funeral homes can lease land out. They can sell land out that they own, plots and things like that, right? So the main reason why final expense protection is important for a lot of people is because they don't have $15,000 to $20,000 lying around for a funeral. If they do, it's not for that funeral, I can tell you that much. It's probably because they were saving up to buy a new car or saving up to pay off the house early, or maybe the kids, education fund, something like that. They're taking money from somewhere and using it for something that they didn't think was going to happen, right? So that's why it's a concern for a lot of people. Now, when I'm talking about final expense, I'm not really talking about just what happens at the funeral home. I'm talking about everything afterwards, right? So do you guys know the average for a funeral nowadays?
$12,000, $15,000.
Right around that. Most people, and that's how I start this out. I'll say, okay, so the first concern a lot of our members have is final expense protection. Mary and Joe, do you know how much a funeral final expenses cost nowadays? And they'll usually say between $10,000 and $15,000. Usually, you might get some people like, yeah, it's like 3 to 5, or you might get some people like, yeah, it's like 30 to 40. Depends on how old they are.
Mhm.
They're younger people. They're like, oh, it's expensive, like 30 to 40,000.
Yeah.
They're right.
Guy told me the other night, it's like, well, it's gotta be like 60,000.
They're right. So if they're like extremely off, don't go, that's really wrong. Don't be like, that's super wrong. Here's the right numbers. Just be like, yeah. Kind of, just like politely kind of make them wrong. Does that make sense? But if they're close, be like, yeah, exactly. Nail on the head. So I say funeral nowadays are like anywhere from $10,000 to $15,000. Right? That's now. And cremations, if you want, I don't know, 5 to 10. Right? If you wanted to do cremation, about 5 to 10. A little bit cheaper. Now, what I always typically do with our members is I project back 20 years and then I project up 20 to 40 years, right? So I'd say if these people were in their 40s, 20 years ago, they were 20 some years old. I remember getting gas in a car. They remember that because that's what they were doing at that time, right? And Andrea,
Yes,
you got gas in the 90s, right?
yes.
How much was it?
Oh, like $1.83 or something.
Maybe even less, like $1, right?
99 cents for unleaded.
Yep, $1 in the 90s for gas.
Mhm.
Right now, gas is $3. Right next door, gas is $3.19.
Last year it was $2.
Right? See, even, right? So, and that was a lot because the pandemic was going on and no one was buying gas, everyone was staying home, that type of thing. But just normal inflation, every 20 years, prices are going to double, right? So inflation every year is like 3 point something crazy percent every single year, right? I think it was the lowest it's ever been 2 years ago. It was like 1%. And that's never going to happen again. It's always been a consistent 3% over the last like 60 years. So what I'm getting at is nowadays cremations are or funerals are 10 to 15,000, right? 20 years ago, same exact funeral, we're probably looking at like 5 to 10,000. So 20 years back. Now, 20 years into the future, we're probably looking at 20 to 30,000. And now, if they're in this, like the same age bracket I'm in, the same age bracket most of our members are, anywhere between like 30 years old and 50 years old, they probably got another 40 more years. They got 40 years in them. I'm 33. 40 more years puts me at 73. That's not even average life expectancy. Average life expectancy for a male is 78. For a woman is 83. I've been told because women, they do less dumb things, that they live longer, right? But I'm also told that they're generally in better health too, okay? So project out 20 more years. 20 more years, when you're looking to use this, 40 to 60,000. Now keep in mind, if they're in their 60s, this is probably where the projection is going to be at, right? But if they're in their 40s and their 30s, right there. Don't be afraid to show them bigger numbers right here.
And then if they're in their twenties, even if somebody in their twenties, it's gonna be what, 60 to 80?
Exactly. As long as inflation keeps going the same exact rate every year, which is done the last 60 years, it's going to keep going up, right? And the one thing I want you guys to realize too, when you're talking to your members about final expenses, like even if you did cremations nowadays are $5,000 to $10,000, depending on what you want done. But once something becomes popular, what happens to the price of it? It goes up, right? Supply and demand. So right now, cremations are pretty popular, becoming more and more common. So the price of those is going to go up or more too down the road, don't you think?
Yeah.
Things you can do with it, be put into diamonds,
I know.
going to be buried into trees, all kind of crazy stuff,
Yeah.
right? So if someone tells you they're going to get a cremation, you can almost put a cremation about $10,000 to $15,000 down the road. You know, some places right now, depending on what you want done. Now, with their situation, you want to figure out what they're going to do after death. You know, it might be a tough question to ask them, and they might not have the answer to it yet because they might not have thought about it. But I usually ask them, like, Mary and Joe, if something happened, do you want to be buried? Do you want to be cremated? Or what do you want done? They're like, oh, man, I never really thought about that. Okay, yeah, I mean, it's a tough thing to think about. I get that, you know. But as you can see, like the cost of the cremation service is a little bit cheaper, you know. So if you're thinking about that, you might want to set something else aside, right? Now, the whole thing that we're doing here is we're showing them the problem, we're making the problem visual, right? And then we're showing them the solution to the problem. The solution to the final expense problem is the freedom of choice certificate. Right? That's the solution to the final expense problem. So the freedom of choice certificate is something that our company developed and that no other company has. No other company uses anything like that, right? And the reason why it was designed is so that our members don't get taken advantage of in the funeral home, right? Not saying that funeral directors are criminals, they're not, okay? All I'm saying is that there's no one telling them what they can and can't charge, right? There's no one going each funeral home and saying, nope, you're above, nope, you're below, you have to charge more, you have to charge less. There's no one that does that, right? So each funeral home is different, right? So why we designed the certificate is because that in this situation, you got to think about it. This person just lost their best friend of X amount of years. They're not thinking clearly. This is the worst time in their family's life. All they really want to do is throw money at problems to get them to go away. And that's what most people do. Most people go into the funeral home and they say, my husband, he passed away. He had $50,000 of life insurance. What can I get for a funeral? And they're going to be like, you have 50 what? You have 50 what? You have 50,000? Okay, well, it looks like with everything here, probably going to be about $49,999. So that works, right? But I'll take care of it all with the life insurance. And that person will be like, yes, take care of it for me. They just pay 50 grand for a funeral that costs $15,000, right? All because they didn't know that you can negotiate with those people. It's not like set in stone. There's not a McDonald's menu board that says cremations this much, funerals this much. They base it off of what they see. So if you walk in there with a large life insurance policy and you hand it to them, they're going to look at the first page, they're going to open it, and they're going to go, 100,000. I know what I'm going to charge this person. Now, I'm not saying that all funeral directors are like that, but that's the way the industry works. What they do is they have a bunch of books, and they pull out a book based on the price range. So if you have a bigger price range, they'll pull out the book with all the nice caskets in it. You have a smaller price range, they'll pull out the small caskets, right? Why the freedom of choice certificate was designed is because there's no amount on there. That's all our member has to bring in there. Our member knows how much they have. Funeral director doesn't. It's like they're playing poker, and our members have all the cards, and they have nothing. So they're going to win every time, right? And a lot of our members are good negotiators. You've been in sits with them. Some of them are tough, right? Especially some of these ladies,
They're tough.
right?
Yeah.
So they're going to get good rates and they're going to negotiate really well if they have the power to do that. Because with the freedom of choice certificate, they have the power to negotiate. All they do is they put what the amount that they want to spend for the funeral at the house, at the funeral home there on the back. They sign it like a blank check, hand that certificate over to the funeral director. And from that point on, everything is taken care of. The claim's being handled, right? She can use that next 3 to 5 days to prepare the family, to start the grieving process, to get all that taken care of. And she doesn't have to worry about where the money's coming from. Because once that funeral director has that certificate, he calls the 1-800 number and 2 checks get issued immediately. 1 check goes directly to the funeral director for everything on the back. Anything left over in the policy gets sent right back to the beneficiary in a tax-free lump sum payment 3 to 5 days later, right? Making it super, super easy for all of our members. So what I would recommend you guys doing is in the e-app itself, watching that freedom of choice video, playing it for your members. It's the best video that's on there. I'll tell you that right now. I don't play many videos myself, but I do play that one almost every single sit, no matter what. Because that's the best thing about our company is that freedom of choice certificate. That's what sets our company aside. Right? Why not show off the best part about our company? I would advise you guys to play all the videos and watch all the videos yourselves a bunch of times, because all the verbiage and everything I'm saying and everything everyone in this agency says is from those videos. You guys remember when we did this, we did it in home with people. So we just used e-app. There was no PowerPoint. We didn't have any of that stuff developed. All that PowerPoint stuff came from e-app. We just transplanted it over to e-app. We wrote it down and put it into words. So we're not divvying too far from the e-app presentation. It's not, right? All we did was just make slides. Same thing, you know? So the final expense protection here, guys, all you really want to do is make sure that they understand, number one, this is what funerals used to be. This is what funerals are going up to. And number two, this is probably the only area where a company is going to recommend whole life insurance to protect. Because that's a when, not an if. Your final expenses are a when. We're all guaranteed 2 things in life: death and paying taxes. All right? I'm from the east side of Pittsburgh. I've seen people get around paying taxes. Never seen anybody cheat death, though. Right? Maybe Evel Knievel once or twice, but he's not alive anymore, is he?
I don't think so.
No, he's not. He's dead. Right? So everyone dies. Even crazy Evel Knievel. Right? So for the second concern a lot of our members have is final expense protection. Mary and Joe, do you know how much it goes into a funeral nowadays? About 10 to 15,000. Yes, exactly right. Right? Nail on the head. 20 years ago, that was probably about 5 to 10,000. Right? So what that means is 20 years down the road, we're looking at 20 to 30,000 for that same funeral. And you guys are in the same age bracket I am. You got another 40 years in you. So we're looking probably anywhere from 40 to 60,000 for that same final expense. And I usually circle it. So if I have 40 to 60 on the screen, on the board there, I usually circle it like that, so they know how much they need. They can see a visual representation of what it costs for the final expenses. All right. So do you guys have any questions on final expenses? How to explain it to them, how to kind of walk them through it, that type of thing? We got to know in the virtual world, we're good here? Okay. So the third concern, or the second pie chart we're going to fill out here, is income protection. Right? Income protection or paycheck protection. So this one's pretty easy to explain, mainly because they see their paycheck. They know what their paycheck does for them. Right? We just have to remind them all the things that their paycheck provides the house. Does that make sense? So income protection, our company typically recommends 3 to 5 years of their peak earning income be protected. Right? So you can ask them right here, Joe, what do you typically bring home every single month? Right? if Joe says we're gonna do a really small extreme example. So if Joe says $2,000 a month, or so if Joe's 2,000 a month, multiply that by 12, 24, call it 25,000 a year, right? Times 5 years, right? That's $125,000. So Joe, 5 years of your income comes out to about $125,000. So what that means, Joe, is you're going to get up and you're going to go to work every day, and over the next 5 years, you're going to bring $125,000 into this house. You're a $125,000 asset to this family, Joe. Right? So Joe, that $2,000 every single month, what does that help you guys provide? He'll say, keeps the bills paid, keeps the phone paid, lights on the table, right? Everything, right? That $2,000 every single month does more than what he thinks it does. He thinks it just pays bills, right? When realistically, that $2,000 every single month is like his heartbeat, right? Because every single month, he's going to get paid. Every single month, he's going to have bills. Paid bills, paid bills, paid bills, paid bills, paid bills. All the way through his life, right? I'm sure you guys have been in a situation where you were up, I got paid really well, right? Next month, damn, I'm down in the hole again, right? It's a roller coaster. It's like your lifeline, like your heartbeat is like that all the time, right? Your heartbeat is up and down, up and down, up and down. The only way that your heartbeat's going to be flat is if what? You're dead. The only way this guy's paycheck is ever going to be flat is if he's dead, right? So that's the lifeline of the house. This week here, that would hurt a little bit, but you could figure it out. You would get by. And they'll say, yes, yeah, we could get by. I'm like, okay. Now, what if Joe's paycheck was cut off forever? It's a different story, right? To compare their paycheck to their heartbeat. I see that we're freezing. Yep, give me 1 sec. 1 sec, Rogota. Here's what we're going to do. We're just going to put it on my hotspot. Solve this problem right quick. Hotspot. Okay. All right, so it's back. I'm going to try to connect this to the hotspot
Okay.
just because it keeps moving in and out. I don't even see my phone on here. All right, is this better?
Yep.
Okay, sorry. All
It's
right,
okay.
so it was probably choppy when I was going over that income protection a little bit, right?
I got all the way until when you said it's the lifeline.
Okay, yes, okay. So now the reason why I use that is because when you're going through the videos of the income protection, that's what it bit lifeline of the house goes up, it goes down, and freezes just like this video, right? So the only time their lifeline's ever going to be consistent or level is if they're not alive anymore, if their heart stops, right? It's a financial heart attack for the family. So income protection, what that would do, it would make sure that if Joe went to work tomorrow and he didn't come home, it would make sure that $2,000 every single month for the next 5 years to keep the food on the table, the bills paid, the lights on. All right. So breaking down what they make every month right here for them visually represents their paycheck. Right? Sometimes they don't see their paycheck. Sometimes it comes in and it goes out just like this. Right? Sometimes the 15th they're like, damn, I just got paid $2,000 and then I had $1,600 in bills. Sometimes it happens. Right? And then there's also sometimes you got paid $2,000, you're like, I'm already up. I don't need all this. Right? So you want to break down both of their incomes though. So if only Joe's working, then just put Joe's in here. But if they're both working, put both their incomes in here. Does that make sense? Use their numbers. Right? Now, I'm going to get back to this in a minute here, but we should also be using this to spend their coverage that they already have. Because you're going to run into people that have life insurance already. You're going to run into people that have terms, that have whole life policies, that have every other policy under the sun, right? It's kind of rare that you run into someone who doesn't have any life insurance, right? So I'm going to get to spending their coverage in a bit, but I want to explain all these really quickly. Now, one good metaphor to use for income protection is if you can't get this across to them here, is called the ATM close or the ATM machine, right? So Stephen, just role play with me here for a second, all right? So let's say, no, you're good. You don't got to move, you're good.
No, I'm not moving.
So let's say, Stephen, that you got this brand new ATM machine and you're going to put it in your basement. And this ATM machine, every single month, it's going to spit you out $3,000 every single month, right? Now, if that ATM machine breaks, you get $0, right? So there's that ATM machine, and then there's another ATM machine that every single month it spits you out $2,800, right? But there's a warranty attached to that one that says if it does break down, you're still going to get that $2,800 every single month. So are you going to get the ATM machine with no warranty or the ATM machine with the warranty? The one with the warranty. Even though you get $200 less a month, why would you get the one with the warranty?
It's reliable.
It's reliable. It's going to be there for you, right? So hate to break it to you, Stephen, there's no such thing as an ATM machine in your basement, right? But the good news is you have a machine. You're the ATM machine. I'm sure your wife's probably called you that. Pump out $3,000 for the family. The only way you're not going to is if you're not here, right? $200, that would go to protecting the other rest of the $3,000. Does that make sense? Right? So I made something that's untangible, tangible, because everybody uses an ATM machine. Everyone knows how one works.
Do you use that line in SITs, like when you're actually presenting to a customer?
Mhm.
Do you use that metaphor?
Yeah, all the time. Hell yeah.
So I'm going to guess you don't have a lot of success with that?
Yeah, I mean, especially with income protection, a lot of people know that that's like, especially when you ask what the biggest concern is, a lot of people say income protection anyway. Right? So that's kind of when I explain it to them. Like I kind of double down on it at that point, you know? But yeah, I mean, I use that ATM close all the time, you know, because they're not thinking about their income in that way. Thinking about, oh, if I just go to work every month, I'm going to bring this home, right? They're life and they're like, I got bills coming in, I'm getting paid. Like they don't think of themselves as that big asset. You know what I mean? House is working. Let's say, for instance, the stays home and takes one kid. All right. I actually build it up more, right? I'd say, Mary, Joe, you guys both working right now? And they would say, Joe would be like, no, I'm the only one working. I would say, Mary, so you got the tough job of being the homemaker, right? And she goes, yeah. Okay. And if she's taking care of kids and doing all that good stuff, guys, her salary should be like $100,000. I don't know if you guys have ever like read the study, like Penn State did a study like 3 or 4 years ago. Did like the average salary of a homemaker with 2 kids, what they would make if they got paid for everything that they did. It's like $100,000. Cooking. Add so I would tell, like, I'd never belittle any homemaker. I tell, if something happened to Mary, you'd probably be screwed more than Mary would be screwed if something happened to you, right? Because Joe's got to learn all these new things and then go to work. Right? Mary already knows how to do all the hard stuff. All she has to do is find a job. Right?
Right.
So I always make sure that if the homemaker isn't there, I would say, Mary, you got at least 100,000 set aside so that if something doesn't happen to you, Joe's life doesn't change drastically either. Right? So Joe's a $125,000 asset. Mary is a $100,000 asset. Together as a family, they need $250,000 in income protection.
So if you're in a SID, so do you also say that in the SID, like the SID stay-at-home mom, it's like, all right, because of how important the job is, what you do, I'll put your income down as $100,000. That's the value. Like, how would you say that to the client? Then there, if like I'm Joe and Mary.
Yeah, so if I'm breaking it down in the needs analysis with them, I would say, Joe, what do you bring home every month? And he would say $3,000. I say, okay, great, $3,000. And Mary, what do you say you bring home? You're a homemaker, right? Okay. I know you don't get, physically paid for that, but we're going to make sure that it's about $2,000 a month that Joe would need if something happened to you. So I would just match up theirs. Do you know what I mean? I just basically tell them 100,000 because that's what that study said. And I want them to think big. I want them to think like, yeah, you're right, $100,000. People like the sound of $100,000, right? So that's why I kind of go with that number, if that makes sense. And I'm just visually trying to represent what all they do in numbers. Does that make sense? So it's not like an exact science of where the number comes from. It's more or less kind of visualizing them to see what their worth is, right? Because they might not see it in a paycheck every month, but they can visually see it. And if something happens, now Joe has to go out, cook, go grocery shopping, take care of all the kids, drop them off at daycare, all that stuff.
Or just say, if he couldn't do that because he was so busy,
He would have to pay
he
someone,
would have to pay someone
100%, Andrea. He'd have to pay someone to do all that stuff, which costs money,
money.
right? So he's either going to be spending a lot of time or a lot of money on other things that normally he wouldn't have to do right now. So that's kind of the way I would if the wife wasn't working or the husband wasn't working, I would still want to protect their income. That's not there anymore. If that makes sense. It's not, their income really isn't there. It's not really coming into the house,
Right.
but the lack of protection there would drastically change that person's lifestyle if they didn't have it. That's the whole thing I'm trying to bring to light to that. Does that make sense?
Yeah.
Good there?
When I go away, my husband's lost.
There you go. There you go, right? He's probably freaking out this week, huh?
He is.
So do you guys have any questions on income protection before I go on?
Yeah, so is that something that would be included in a whole life policy? Would that be combined with the funeral final expense part of it? Or is that a decreasing term?
Good question. So typically when they recommend income protection, it's typically recommended for a 10-year R&C, typically, or a
Okay.
20-year level, depending on the age of the person. But you guys can, once you become an expert at doing this and do it more often, and you can help this family. Like, let's say that this $125,000 10-year term costs $180 a month, right? That's not in his price range right now. What you can do is you can get him $200,000 of accidental and kind of use it as the same exact thing. See what I'm saying? $200,000 of accidental is $16. If he's in his late 30s, early 40s, the probability of him because of an accident is very high, right? The number one cause of death in America under 50, accidents. Over 50 becomes heart disease. Under 50, it's accidents. So the most effective way to typically cover either someone's income or mortgage when they're young is accidental coverage, right?
So that's what's
So-
included with the funeral final expense. So you would just add the AD&D on the funeral final expense of the whole life, and 200,000 is the max that you could get.
Correct. So the base
Okay.
plan in this situation would be the whole life final expense, and then there would be a rider for income protection of a 10-year term or accidental.
Okay.
Does that make sense?
Yep.
Okay.
What was the question that 10-year RNC and 20-year level was the answer to?
Okay. So yeah, good. The question was, how does it typically get projected to the member? Like, how does it typically get covered? Right. So this is how it typically final expenses cover with typically whole life.
Okay.
So typically when the needs analysis spits out what it recommends, it'll spit out, it recommends 10-year term for this amount of money, right? If we did this example and the needs analysis would spit out that Joe needs $125,000 of income protection, that would cover 5 years of his income, and it would be a 10-year RNC for that amount of money, right? So a lot of the factors go into this though. Like, once you become more comfortable with the product's knowledge and actually helping the member out, you can customize things to them. Like, I know that, like, for instance, if this instance here that Joe and Mary, they were in their late 30s and their kid was 10 years old. A 10-year term might be good for them because that puts that kid at 20 years old. They're going to live through a lot of liabilities in the next 10 years, paying off the house, getting the college education set up, things like that. Those next 10 years are very crucial to that family. So that's why you want to protect it for 10 years, right?
Okay.
Now, if they're in their mid 40s and their kids are 17, 18 years old, if they pass away, the kids aren't 2 and 3, they're not going to panic. Like, they'll be able to figure it out. Might take some time, but they'll be able to figure it out, right? So at that point, maybe accidental would be a little bit better, right?
Okay.
So you just got to remember what their liabilities are at that situation. Like, if they're liable for the next 10 years, like, that's the most important area to protect for sure. Make sure they have that coverage, right? But income protection, more or less making sure that you paint a picture of one member not being there and showing them and asking them what their paycheck really does for their family, like breaking it down. Like, I know your paycheck brings money into the house, but what does that help provide you guys? Like, does it pay the cable bill? Does it make sure the heat's on? Right? Does it pay your car payments? All that good stuff. All right. So the fourth concern, or the third one on the pie chart here, is mortgage protection. Or rent protection. Right? This one's pretty easy to explain, pretty easy to go over, mainly because they live in the house. It's not too untangible of a thing. They live in the house every day. They come home every day. They sleep in the bed every day, right? So the one thing about the mortgage that a lot of people don't realize is that if they have a mortgage and they pass away, the bank's not just gonna be like, oh, you died. Sorry, your mortgage is forgiven. Go ahead and own the house. Right? They're gonna knock on the door next month and be like, hey, You forgot to pay your mortgage last month. One more month of this and we got to foreclose on the house. So the mortgage company does not care that you passed away. Right? They're still going to ask for that bill every single month. And the way I kind of start the mortgage protection questions off to them is I usually say, Joe and Mary, do you guys rent or do you own? If they say own, I'm like, okay, great. Do you own it outright or do you still have a mortgage payment on it? And most people are like, oh, we still have the mortgage payment on it. I would say, okay. So if you had to say, you know, what would you say your biggest asset is? Right, Joe, what would you say your biggest asset is? And typically they're going to say the house. My house is the biggest asset. And I would say, okay, now you just told me, Mary and Joe, that you didn't have the house paid off yet. You still have a mortgage on it, right? So technically, you don't really own the house, do you? And they'll say no, because technically they don't. The bank owns the house, right? And until that mortgage is paid off, the bank still owns the house. So until that mortgage is paid off, that's actually the biggest liability that they have.
Well, with the FHA, there's different kind of mortgages, so with the FHA, that's already covered. If they die, they have to have an insurance policy.
So there's two different types there. I'm glad you brought this to light. So when people have mortgage protection already, they might be thinking of what's known as PMI or private mortgage insurance, right? Private mortgage insurance does not protect the member. That protects small banks from big banks. Okay? So private mortgage insurance really is only applied if that person puts less than 20% down or until they paid off the principal of the loan. Once that's done, the PMI usually falls off. So now the reason why PMI exists is because if you go to if I went to Chase Bank, the local Chase branch up the road here, and I asked them to borrow $300,000 for a house, do you think they have that much money on hand to just loan me? No, they don't. So where do you think they get that money from? They get that from the bigger Chase Bank, or they borrow it from a bigger bank, right? So that bigger bank wants paid back.
Mm-hmm.
So what the small bank does is they put what's called PMI on your loan,
Mm-hmm.
and they charge you an extra $50 or $60 every month.
Mm-hmm.
So that if you die, the small bank doesn't owe the big bank that money back.
Okay.
It has nothing to do with the member. The member gets none of that money.
Okay, so the member still has
Still the bank.
still has to pay the money too, so that's really not covered.
Correct.
What about for the FHA? Is that the same way?
If it's an FHA loan, sometimes they are forgiven.
Okay.
Yeah, it has to be in the writing though.
Okay.
So most of the time, if it is FHA, that means they got it through like a credit union or like usually a bigger bank to begin with,
Okay.
and that they're very qualified too,
Okay.
right? You have to remember, not everyone's in that situation.
Right.
The one thing so some people might have mortgage protection though. Some people, if they have like a policy through State Farm, they might have like a mortgage protection for $200,000 the last 30 years. And it's, I don't know, $60-$80 a month, right? But typically people don't have protection set aside just for the mortgage. Like that money is there for a lot of things, you know?
I didn't realize the PMI was set up like that with the owner's statement,
Mhm.
that was paid off, it's still, if they have.
It's mainly because that person didn't put enough money down.
Okay.
That's the main reason why they make people get PMI. Or if your credit's really bad,
Mhm.
they make sure that they have those extra incentives to get paid back,
Okay.
right? But mortgage protection, I usually ask them if they own a mortgage, like how much do you guys owe left on the mortgage? And they'll just tell me. Like let's say in this situation, it's like $100,000. So they owe $100,000 left on the mortgage. And I would say, Joe, if something happened to you, who would be responsible for that mortgage protection? He would say, Mary. So how would Mary be able to pay for that mortgage with no income? Right? So that's a huge concern for a lot of members, is making sure that you can still live in the same house. Your family doesn't have to pick up and move. Right? Because I don't know if you guys have ever sold houses or ever gotten to that market or ever done anything like that. It's
I
not-
just got my license.
It's not fast. Selling homes isn't fast. Doesn't happen tomorrow. Doesn't happen in a week.
Mm-mm,
Sometimes not even 2 weeks.
mm-mm.
It's months,
4 months for the last one.
right? So if people think that they're like, oh yeah, I own this property, I could sell it like this. No, you can't. They can't do that. It's impossible. Unless you know someone that got 200 grand in cash lying around that's willing to give you that. Sorry.
It's not updated or weird.
I'm telling you, the bank's not just going to give you 200 grand for that house right off the bat. It's not going to happen. A lot of people think that, oh yeah, I own this house. They can just use this to sell the house and pay off everything. They might be able to pay it off and take care of maybe the income protection, but they're going to need 30 to 40 grand up front. Still going to have to borrow that money from somewhere, you know? So mortgage protection, it's one of the easier things to talk about though, because it's a tangible thing. They see their house, they live in their house, right? Most of the people we sit down with have been in their home for 10 plus years, right? It's not a house anymore, it's a home. They put their memories and their life into it.
What if it's a young couple too that just got the house and they're planning on that being their forever home?
Even more reason to do it, you know, because that's a huge asset. Like once the house is paid off and once you own that, that's yours.
Mhm.
The only thing that they have to pay is property taxes, a couple $1,000 a year.
And then you're-
Own that house. Like I can't think of a better asset to leave your family or better nest egg to leave your family than to leave them a house. It's huge. All right. So the one thing we want to get across to them is what their mortgage costs or how much they owe. So Mary Jo, how much do you owe left on the mortgage? Oh, about 100,000. Okay. So typically, and the way that the needs analysis would recommend covering this would be either accidental death or a 30-year decreasing term. Typically those two. So do you guys have any questions on mortgage protection? No? All right, good. All right, so child education or debt / legacy. All right, There's a couple of different things you can pop in there.
I've got to sit at 2 o'clock.
Okay, that's cool.
Your office is the orange, right?
Correct.
Can I use it for the sit?
Yes,
Okay, thank you so much.
no problem, man. So child education, debt or legacy, right? This one could be this fourth pie chart or the fifth concern is a couple different ones combined. And yours right? Or if they're older, they don't have kids, they got them all out of the house, making sure that they have a legacy built up for them down the road. I don't know why it's still funky over there. But we're kind of going to break down all three real quick, okay? So child education is probably the easiest one to go over, right? The way I start that is I would say, Mary and Joe, I'm sure you want your kids to go to school, right? And most people will say, yeah, I want my kids to go to school. I say, okay, well, at the company, we usually say if you're not here, at least give them an opportunity. Give them an opportunity to open up a business, go to trade school, go to a 4-year university, just to better themselves, right? Because you got to think, guys, what do parents send their kids to school for? To better their futures, right? To feel like what they're doing for their kids is bettering the next generation, right? So they send their kids to college. They send their kids to trade school. They give them money to open up businesses, to give them a better opportunity than they had, right? So I asked them, I said, do you know what it costs for a 4-year university nowadays? And they'll be like, oh, a lot of money. They usually might be like, yeah, it's probably about 100,000. I've had some people tell me it's about 100,000. But most of the time they're like, oh yeah, it's really expensive. And I would say, yeah, I know it is expensive. Probably about 100,000 bucks. All right. So that's not a lie. I graduated from college in 2011 from West Virginia University. Okay. So it's not a big school.
Right.
And I paid out-of-state tuition. My first year was like 13 grand. I ended up at the last year there was like $24,000. So I owed about $84,000 in student loans. And I was there for 5 years. Keep that in mind.
Okay,
I was there for 5 years,
5 years.
right? So what comes into play here is that I had to take out a loan to go to school.
Did that include your,
So and I had to take out loans to go to school. My mom raised 5 boys. There was kid $100,000. Never bring, but at least the liability. She got out of school and got. All right. I'm so sorry. What was the last thing you heard?
You were saying about, do you want your kid to go to college and how much you think it's gonna cost? I think I missed a
Okay.
bit.
This Wi-Fi is just the worst. I don't get it. I just don't get it. And I'm on the one for Zoom. It's not like I'm using any different one. Yeah. Rogada, what I'm gonna do is I'm just gonna find the recording from 2 weeks ago and just send it to you. Because this is just gonna keep happening. Because there's so many
Okay.
people in SITs right now. I'm just gonna get that recording and send it to you. It's the
Okay, do you
same
have my
exact thing I was
email?
going over.
Yeah, you have my email. Okay.
Yes.
All right, then I'll just hop out of here then, and then I'll just wait for that, and I'll just pick up where you left off
You
here
can
with,
kind of just fast.
yeah, to college education. Okay. Thank you.
Perfect. Yeah. Just pick where I left off at and you should be good. Okay.
Okay.
All right.